Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is May the 23rd, 2023. It is just after 3 o'clock now, Central Time. Still just under an hour left in the mortgage-backed security and bond market trading day. Now, we have been watching and waiting for a while to see home loan interest rates begin to come back down. And at this point, we start to ask, what is it going to take? This is what's going on right now. So we have been seeing for the past week plus days of losses in the mortgage-backed security market and increases in interest rates just a little bit at a time each day. So we'll lose 18, 14, 22, 14, and it's just been we just really haven't been taking many advancements in towards interest rates coming down, even though we have seen inflation coming down convincingly over the first half of this year. And now we're hearing about maybe the Federal Reserve not increasing the federal funds rate in the next coming meeting. Maybe at one point they were talking about bringing the federal funds rate back down at one point after we received some numbers earlier in the month. But yet we continue to see home loan interest rates getting worse day after day. At this point, once again, as you watch this channel and you learn how all of these things play a part, we are seeing a sell off in overall bonds and mortgage backed securities in order to shore up the losses in the banking world. That is all that we can really point to right now. And we can see charts where we're showing massive withdrawals from banks and then deposits into money market accounts and other types of accounts that unfortunately the banks are having to go and find other sources for shoring up their overall balance sheet in order to continue to operate properly. Now, again, selling bonds and selling mortgage-backed securities places more of those on the market. That creates inventory in the bond and mortgage-backed security world. And in order to absorb that inventory, they have to make those bonds or mortgage-backed securities more attractive than new ones being sold by offering higher rates of interest. So that is what we see right now. That's really what we're pointing at right now, because overall, we have seen inflation coming down convincingly in the first half of 2023, just like we talked about. If you go back and you look at the projections that I put out back in January, we were talking about the charting that we saw for the PCE and the CPI and inflation readings and all of those things, what we thought the Federal Reserve was going to do. And it has really been following suit. I will say not as aggressively as I had projected, seeing month over month numbers of 0.2, but we're getting 0.4s. I mean, obviously, that's a lot higher than what I was projecting. There's all kinds of questions as to whether these reports are being manipulated in some way, because we're just not seeing it in the world that we live in. When we look around, we don't see booming numbers when it comes to employment, but yet we're getting reports that employment is through the roof. So we've had a lot to deal with in the first half of this year, and going into the second half. What do we hope is going to happen? Well, understand that we are going to be getting the personal consumption expenditures reading that we're going to receive this month, which is for the month of April. So this will be something that, again, may help to turn the tide, and we may help to see a reversal and begin to see home loan interest rates improve again. Now, again, we've had a fairly substantial increase, increase in home loan interest rates in the past couple of weeks. And again, things don't just go straight up or straight down. They seem to have more of the roller coaster activity. So I do think that we're going to see some improvement here, just even from a reprieve perspective. But I think there's other reasons to see things getting better. Now, the other thing that I thought about, and this may have to do with the banking industry, is we're seeing a lot of money moving around. Okay, a lot of large amounts of assets moving around. There's another thought that could be the case. What if a lot of people are seeing these really, really wealthy investment firms and individuals say, look, rates are as high as they're going to get. They're going to come down. Now is the time to buy these assets while they're at their cycle peak. They're as high as they're going to get during this cycle. So maybe there's enough indicators out there that people are also seeing this as the peak environment to buy long-term fixed assets. Maybe that's part of it as well. Let's take a look and see where we are. First of all, let's go to our charts here. And again, we are seeing a down day, only down 3 at the moment, down 2 on the 10-year treasury, which is good. But look, we're at 3.7 now. Unfortunately, above that 3.5 that we never like to get above. Here's the mortgage-backed securities that we've just seen day after day after day, just trickling down, breaking below all of our, moving averages, quite a few of the Fibonacci levels. And now look at when we do take this turn, how many ceilings we're going to have to break through to finally get up into this range. And I talked about a few days ago, or maybe even weeks ago at this point, that when we do get into this range, this is going to be, go back here, oops. This is where it's going to be interesting, because when we do get into this range again, we're going to be able to very quickly break through all of these moving averages as well as Fibonacci levels, and then we'll have a lot of room to run. But as you can imagine, we're going to have a lot of momentum behind us, a lot of force behind us to break through these and then get back to where we previously were. Same thing when it comes to the 10-year treasury. We got the same situation. Now, this chart, again, we do not want this to go up. We want this to go down, but you can see that it's been on a run, breaking above all of the moving averages, Fibonacci levels, and now we're all the way up here where maybe 380 is the next ceiling of resistance over the top of us. Not a great situation to be in. We need all of these to turn around and begin to see them come back down so that we can begin to make that run, which I think could be fairly substantial. I think when something convincing happens, we could see a pretty quick reduction in interest rates. You may remember not too long ago, I want to say it was 2 or 3 months ago, that within a month we had a full 1% drop in interest rates. And then it turned around and we had a full 1% increase in interest rates. I have seen interest rates move quite a bit. I believe I saw about I want to say a 1.75% change in interest rates in a month. So they can move rapidly when there are major movements in the economy. So let's take a look here at where we are on our home loan interest rates as of today. Let's pull up our Brent Bruce daily scenario, which is our very well qualified 30-year fixed conventional home loan. It's been a couple of days, guys. I've been pretty busy here trying to stay on top of really all the conversations that I'm having, the questions that I'm having, and believe it or not, putting new loans in process. All right. So here we are at 6.875% with a credit of $166. Now, again, this is with the loan store. You remember me a few days ago telling you that the loan store purchased one of the banks that we were previously working with, which was Home Point, and you can see them being very aggressive. Smart move. Be very aggressive as you're coming in order to cater to and accept all of these clients from Home Point and show them what you can do. So down here, going a little further, 11 Mortgage, Flagstar, 11. Now, United's all the way down here. Again, United is the largest wholesale lender in the United States. 6.875 is costing $839. We like to take a look and see where the 5.999 is. Now, you remember, not long ago, a 5.999 was costing less than a half of a point. Right now, it is costing just about 2 points. Okay, that is 1.5% more expensive to get to that 5.999 because of the run that we have seen in the market here. And I'll show you what I'm talking about very quickly. All right, from this range here to this range here. All right, that is where we saw that large change. 5.875 with no points a while back, right? So let's take a look again at what our scenario is. We're going to open this up here. This is showing our parameters for the scenario that we looked at. So what are we waiting on? We are waiting for this Friday, which is the 26th, to get our personal consumption expenditures report and hopefully begin to see that turn around. Tomorrow, we are going to get the notes that come out about the discussions and the comments from the last meeting of the Federal Reserve. Sometimes those are market moving because we look a little bit deeper into what they were talking about and what they were thinking. However, they're they're very protective about what they say. They don't ever want to say anything that really makes you believe one thing convincingly, because they continue to get new reports and they may want to modify that, and they don't want to surprise the markets. So again, at the beginning of next month, the Federal Reserve will meet again, and we'll hear what they're going to do with the federal funds rate. So there's always a lot to come. Unfortunately, home loan interest rates have been drifting consistently up for a while now, and we're starting to flirt with that 7% number that we haven't been at for months on the Brent Bruce Daily. Hopefully we'll see it turn around, and that 7.0 will be that psychological ceiling that we bounce off of and head back down and start to look back into the fives. I'll keep you posted. We'll talk to you again soon.